Recent developments in the forex market have generated intense debate, including predictions of rupee dropping to record lows as foreign portfolio funds exit India. I would like to address the issue in a balanced and factual manner, and I have attempted to be as objective as possible. First, it is important to recognize that spillovers from the global monetary policy tightening, the geopolitical situation, the still elevated commodity prices, especially prices of crude, and the lingering effects of the pandemic all coming together have become overwhelming for countries world over. Even reserve currencies such as the Japanese yen, the euro, and the British pound sterling have not been spared. Portfolio funds are selling off assets and fleeing to safe haven. Emerging market economies are particularly affected by capital outflows, currency depreciations, and reserve drawdowns, complicating macroeconomic management in these countries. Second, the impact of these overwhelming spillovers on India has been relatively modest. In fact, the Indian rupee is holding up well relative to both advanced and EME peers. This is because our underlying fundamentals are strong, resilient, and intact. The recovery is gradually strengthening. The current account deficit is modest. Inflation is stabilizing. The financial sector is well capitalized and sound. The external debt to GDP ratio is declining. The foreign exchange reserves are adequate. Third, in recognition of the fact that there is a genuine shortfall of supply of forex in the market relative to the demand because of import and debt servicing requirements and portfolio outflows, the Reserve Bank has been supplying US dollars to the market to ensure that there is adequate forex liquidity. After all, this is the very purpose for which we had accumulated reserves when capital flows were strong. And may I add that you buy an umbrella to use it when it rains. Fourth, a predominant part of the outstanding ECBs is effectively hedged. Let me elaborate. According to the June 2022, the last month's financial stability report of the Reserve Bank, the outstanding ECBs of the outstanding ECBs of 180 billion US dollars, 44% or 79 billion US dollars is unhedged. Now this includes about 40 billion dollars liabilities of public sector companies, mainly in the petroleum, railways and power sectors, which have assets with a natural hedge character. Besides, being public sector entities, their foreign exchange risk, if any, can be absorbed by the government if so required, but that possibility is highly unlikely. The remaining US $39 billion ECB represents 22% of total ECB's outstanding. Even this includes borrowings of those companies which have a natural hedge, that is earnings in foreign currencies. This would leave a small portion of the total outstanding ECB that are truly unhedged. So it is necessary to look, the so-called unhedged forex reserves in its proper context, rather than get carried away or get alarmed by what is revealed on the surface. We need to look at it deeper, we need to dissect it and look it in a manner that is objective and fair and true to facts. So that's why I'm saying that the truly unhedged portion of our so-called unhedged ECB outstandings are far too lower than the $79 billion, about which I think there has been some conversation in the recent days and weeks. Now, corporate entities eventually face a trade-off. If they hedge their foreign exposure completely, the cost of borrowing goes up and the advantage of cheaper borrowing in foreign currencies is lost. On the other hand, to the extent they do not hedge, debt servicing can go up when the exchange rate is under pressure. This has led to the concept of optimal hedge ratio, which calculates the proportion of hedging that minimizes the variance of portfolio. For India, our internal research, that is the internal research of the Reserve Bank research team, estimates the optimal hedging ratio at 63%. In fact, this was one of the bulletin research articles which was published sometime perhaps last year. Now, taking into account natural hedges and the exposure of public sector companies, the optimal hedge ratio condition of India at the moment is comfortably satisfied in the case of the stock of ECBs, in which, ECBs in India's external debt. Due to the RBI's actions, including measures to encourage inflows, the movements of the rupee have been relatively smooth and orderly. By eschewing sudden and volatile shifts, we have ensured that expectations remain anchored and forex market functions in a stable and liquid manner. We will continue to engage with the forex market and ensure that the rupee finds its level in line with its fundamentals. I would like to reiterate that we have no particular level of the rupee in mind, but we would like to ensure its orderly evolution, and we have zero tolerance for volatile and bumpy movements.
If you like the video, do like, comment, share and subscribe.